afternoon, and thank you for joining me on today's QuickBooks Enterprise webinar. My name is Kathryn Butts. I'm a senior consultant at Fourlane, and today I'll be discussing cash flow. We'll look at the statement of cash flow in QuickBooks and learn how to read that report. We'll also look at the cash flow forecast in QuickBooks to learn how that data can help us predict our use of cash. We'll also look at an example of a 13-week cash flow model that you can create outside of QuickBooks in Excel using reports from QuickBooks. When I review financials with my clients, I tend to focus a lot of attention on the balance sheet. A reconciled balance sheet means that we can tie out all elements on the balance sheet either to an outside statement, like a bank statement, credit card statement, depreciation schedule, or to an internal subledger, like the inventory valuation summary or the AR aging summary. After the balance sheet is in good shape, we look at our profit and loss. We look at comparisons between periods and to ensure that there aren't significant variances that we weren't expecting. We look at these reports and we get a lot of insight and meaning into the performance of our business. We can look at the change over time, we can run KPIs, and oftentimes one important question remains. Well, if my net income looks good, how come there's not more cash in my bank account? Or how can I have money in my bank account if my books are showing a loss? Profit doesn't necessarily correlate with money in your pocket, and that can be hard to see on the balance sheet and profit and loss. But that's where the focus of our discussion comes in today. We are going to look at our statement of cash flows to help us understand the net change in cash over time and how we can better use cash within our business. Now, I want to stress that the cash flow report is only as good as the data within, which means that a properly structured chart of accounts, which has the correct account types selected, is essential to your cash flow statement being accurate. A fully reconciled set of books with a solid month-end close process also helps to ensure that all of our reports, including our cash flow, are accurate. Good workflows and checks and balances are essential for all aspects of managing a business, and we'll see that come into play as we review our reports today. So let's take a look at what QuickBooks has to offer for us. We're going to pull up our statement of cash flows by navigating to Reports, Company and Financial, and then down at the bottom, we're going to use our statement of cash flows. The statement of cash flows can be intimidating to read, so let's go step by step to understand where these numbers come from. This report can be set for any report period, and I'm going to use year to date in my sample file. A cash flow section report is broken into three sections: operating activities, investing activities, and financing activities. After reviewing your cash flow statement within your own books, if things don't quite look right, you can reclassify how the statement of cash flows is presented. QuickBooks uses a standard format to generate the cash flow statement, but if you need to make an adjustment on how this report looks in your books, you can make modifications by going to Edit, Preferences, Reports and Graphs, and then the Company Preferences, and then Classify Cash. If you needed to, for example, move an account from an operating activity to an investing activity, you can do that by changing the check marks in this section. However, if you are thinking that your statement of cash flows doesn't look right, I'd recommend a review of your chart of accounts and month-end close process as good first steps to improve that reporting. We're going to go through each of these three sections: operating, investing, and financing, one by one. But first, I want to direct you to the bottom of the report. Cash at the beginning of the period and cash at the end of the period. This is really what the cash flow statement helps us to understand. How did my cash get used up in this period? We are looking to solve how our cash started out the year at $315,000 and ended the year at $186,000. This is what this report is going to help us solve. I will also note that on the statement of cash flows, that QuickBooks is going to include undeposited funds in your cash numbers as a cash equivalent, which means that undeposited funds is a version of cash because those funds are quickly and easily converted into cash. The first section of our cash flow statement is operating activities. Operating activities show cash flow that's generated from our normal business activities, selling goods and services, or running our business. The first line here is net income, and net income comes directly from our profit and loss. In our profit and loss, we have a profit, net income of $19,731.97, and that's exactly where the cash flow is pulling that number from. This $19,000 in net income is going to add to cash. So we're going to start out with a positive number at the top of our cash flow statement. If we had shown a loss, that number would be a negative on our cash flow statement. You think about why that number is a positive, because after we recognize our income, cost of goods, expenses, we have a positive result. We have net income, and that gets added to our cash balance. The next section here, we're going to see accounts that typically become current assets and current liabilities. Now, these accounts are used in the day-to-day management of our business since they show short-term activity generally used in operations. Let's take a look at the balance sheet from the beginning of the period to the end of the period to see how the change in these numbers gets reported in the cash flow statement. First, let's look at the cash flow statement for my accounts receivable. AR is showing a positive $61,358.46. Again, think of that positive number as something that's adding to cash. On the left-hand side of my screen is a balance sheet as of January 1st, and on the right-hand side is a balance sheet as of today's date. Now, if I look at my accounts receivable on the left, on January 1st, I had $102,000, and as of today, that number has decreased to $41,000. Well, what happens when our accounts receivable goes down? Typically, that means that we've gotten paid. We've received money in, and that is why that figure is showing up as a positive, adding to cash. Let's look at another example from our statement of cash flow. Let's look at prepaid inventory in transit. Our cash flow statement is showing this as a negative $8,500. Let's take a look to see how that change occurred. Now, if I look at my prepaid inventory in transit on January 1st, I have a balance here of $15,000 that has increased to $23,500 as of November 13th. The difference between those has increased $8,500. Now again, think about how that number increased. I have increased the amount of deposits I've put on inventory, therefore using cash of $8,500 to cause that number to go up. That number is negative because I used cash to increase that prepaid amount. On the liability side of our cash flow statement, you're going to see some similar examples here. Let's look at my credit card. My credit card, again, has a negative $12,637.45 on my cash flow statement. Remember that these numbers show the change. If I look at my balance sheet from the beginning of the period to the end of the period, I'm going to see that my credit card balance has decreased. We started out at 18 and we're now showing about 5,800. I've used up cash to pay down that credit card. That's why that number is showing a negative. It has a negative impact on my cash. Accounts payable is going to be the same story. I have a big negative in accounts payable, negative $125,000. Well, how did that happen? My accounts payable at the beginning of the year was much higher than in my current period. At the beginning of the year, $133,000. In my current period, $8,000. Well, how did that number go down? It went down because I used up cash to pay those bills. Therefore, using up cash, therefore producing a negative number on my cash flow statement. I used up cash to create that change in accounts payable. Payroll liabilities and sales tax have increased on my cash flow statement. Therefore, I can take a look at my balance sheet for that same period, and I can see that I actually didn't even have those balances at January 1st, but I have currently a payroll liability of $1,800 and a sales tax payable of $229. Now, think about how sales tax is collected. How do we post into that sales tax payable? When we invoice our customers, we're going to invoice including sales tax. That sales tax is something that we collect when we collect their funds, therefore increasing that sales tax payable balance. Now, that money, as I collect it, is increasing the cash that I have in my bank account. That's why that number is showing a positive balance. Once I pay that and that liability balance decreases, well, that's where I'm going to see the negative because I've used up cash to pay down that liability. Our operating section is really our day-to-day operations, and we do expect to see lots of different accounts with activity here. Keep in mind that the statement of cash flow only shows accounts with changes during the report period, so not all accounts from your financials will show up here, only the ones that had a change from the beginning of the period to the end of the period. The next section of our cash flow are our investing activities. Typically, this is going to be long-term investments in our property, plant, and equipment. It might also include intangibles like patents or goodwill. You'll notice here that my company invested in 2 pieces of fixed assets during this year. I bought a forklift and a new delivery van. This is also going to include the activities posted in my accumulated depreciation or accumulated amortization account. In this period, I added about $45,000 worth of machinery and equipment for my forklift and $50,000 worth of vehicles for my new delivery van. I also recognized $22,000 worth of depreciation. Now, I paid cash for my $45,000 forklift, but I took out a loan for that delivery van, and we'll take a look at that in our next section. The last section of our cash flow statement are our financing activities. This is going to include both debt and equity transactions. In my financing activities, you can see that my vehicle loan for the Toyota has a negative value of $2,320, meaning I have used up cash to pay down that note of $2,300. The same is true with my SBA loan. I have used up cash to pay that down by $9,600, and we can confirm that by comparing our beginning and ending balances of those loans from our balance sheet. Toyota started out about $48,000 and ended about $46,000, and my SBA loan started at about $245,000 and ended at $235,000. So that change in those numbers used up cash, therefore the negative balances. You're also going to see that I have my new vehicle purchase, and this amount represents the total amount of the loan less any payments that I've made. And those numbers do offset each other. So if I took out a $50,000 loan to finance the vehicle that I purchased up here in investing activities, I'm going to see that that $50,000 is represented down here, less any of the payments that I've made in that current period. The financing activities section of my cash flow is also going to include any equity transactions. If I had made a contribution of equity into the business, this would have increased cash, therefore a positive number. But in my case, I took out a distribution, which used up cash. So that number is going to show as a negative. You'll notice that at the bottom of each of these 3 sections highlighted in blue, there is a line that says net cash provided by. So net cash provided by operating, investing, and financing. If we add each of those 3 lines up together, we get the total net increase or decrease for the period. In our case, the 3 sections add up to a net decrease of $128,000, which is going to explain the difference between my beginning cash of $315 and my cash at the end of the period, which is $186. So by reviewing that combined activity of the changes that's occurring both on my balance sheet and the net income from my P&L, I'm able to trace out the change that occurred in my cash in this period. Now, there is another report in the cash flow section of QuickBooks that I want to share with you, the cash flow forecast. Once again, think of this report as pulling data directly from QuickBooks. And we navigate here from the company and financial and then the cash flow forecast. This report is looking at three primary things: accounts receivable, accounts payable, and activity posted to the bank account. You can customize this report for different date ranges, but the default is the next 4 weeks, so that's where we'll begin. If there is one thing to take away from this report, it is that due dates on your transactions matter. Why? Well, because that is how this report is able to look ahead to see when those AR transactions or AP transactions will become due. For example, if I look at the week of November 17th in accounts receivable and I double click, I'm going to see that I have my transaction dates here and the due dates are within that week period. Therefore, QuickBooks is producing my accounts receivable will increase my cash flow here by about $13,000 in that period. The same is true on my accounts payable side. If I look at the week of November 24th and I look at this 2650 and drill down, I'm going to see that I have 2 bills that are dated in October, but I expect to pay them. Their due dates are at the end of November. I must have had net 30 terms with those vendors, therefore decreasing my cash by $2,650. This report does have some limitations, specifically in the third column here where it says bank accounts. Most of us aren't dating transactions in the register in the future, so this aspect of the report leaves a little bit to be desired. However, I think it can be helpful to look at the net inflows, even of just my accounts receivable and accounts payable, to begin looking at what that projected balance is going to be. Now, if you do want a little bit more depth to predict the use of cash in your financials, we do have a way to be able to do that using a 13-week cash flow statement in Excel. Now, this is a more complicated model. What we've been looking at for the past few minutes is looking at the past usage of cash on a cash flow statement. Remember, that's looking at what happened in the past, and that cash flow forecast is attempting to look forward into the future. But this report is working towards telling us from today's date, moving 13 weeks ahead, so 13 weeks in a quarter, what can I expect my cash to end up, knowing all of the pieces of the puzzle that I can identify at this time. So let's look at this report together. I've entered my starting date and my beginning cash balance. Then I begin filling in my data, working from what I know to what I don't know. For example, I'm going to take an export of my AR aging detail out of QuickBooks. You can see here I exported that report. And the way that this report is designed is that I can copy and paste these columns into the Open Invoices tab. You can see it's pretty much identical information in there. And then by using some Excel magic in this formula, and I won't claim to be able to read this formula back to you here, but by reading this back, QuickBooks is able to lump these column totals together and use that to populate out my cash flow. The same is true with my vendor payments on AP. I copy and paste an exported AP aging detail into this tab, and that report can be used to populate out my vendor payments, my bills in AP. Now, if you look at the way that this summarizes, these are the positive numbers. That's my cash inflow, and then I have my cash coming out. Because this is in Excel, you are able to customize this many different ways. Some people might choose to include non-posting transactions such as open POs and open sales orders in this data to be able to better predict that flow of money. So if you think once an open sales order becomes due, then that starts to kind of work its way through our accounts receivable cycle, and the same thing is true with purchase orders. There's other factors that are going to affect this model as well, and those are important to think about here. One of our major expenditures of any business is payroll, and I have inserted a line in here specifically for payroll. Now, I know that the total cost of my payroll, including wages, taxes, and benefits for my employees, is about $12,000, and that I pay biweekly. But I also know that I have a commission that's going to become due for commissions and bonuses in the middle of January. So I need to be able to kind of take those numbers and predict how that's going to affect my cash that week. I also have a credit card payment that I know is almost always about $13,500. So I can begin to predict that once a month, you can see the interval here of every 4 weeks, I'm going to have to part ways with about $13,000 in cash for my credit card payment. Now, as I get that credit card bill and I begin to understand how much that money is going to be, I can always update these numbers with the exact totals. So some of the data that we put in this cash flow model is an estimation, some of it's a bit predictive, and then some of it's based on actual numbers. The idea is that once a week, as we begin to recognize our AR, our AP, we begin to see these numbers actually develop within our financials, that we are updating this weekly so that we can always be looking ahead and always be looking ahead to predict what that cash is going to be. There's other transactions that I need to put in here in my cash flow model as well. For example, I've got some loans that we were looking at on my statement of cash flows. I understand here that I'm going to have a payment on my SBA loan of about $1,100 once a month. So I've included that in here. I also have my 2 car notes, a Toyota and a Ford. And again, those intervals are posted in here. A little bit of interest income that runs through my bank once a month, as well as kind of a stated overhead cost for rent and utilities. Generally, we know that our overhead costs can be somewhat predictable, but again, if that's an estimation, I can use that estimation and update it as those numbers become true. By using this cash flow model, you are able to take a look at how your beginning and ending cash is going to work its way through the books. One of my mantras is what you can measure, you can manage. So having this as a tool at your disposal to be able to predict the use of cash for 13 weeks out is really invaluable. Looking backwards with the statement of cash flow to see actually how the money did get used also provides us great insight into any efficiencies that we might be able to build up in our processes. We need to be able to look forward with this model into how our cash receipts and outflows will affect our cash balance, and that can help us to gain more control over our business. We need to be responsive to the actual data that's working through our system, because wouldn't you want to know if you need to take a draw out from your line of credit before your cash situation becomes dire? Or plan ahead for how commissions and bonuses will affect next month's cash? Or maybe you have a little wiggle room to negotiate when a large vendor payment might be due, or it's time to start calling up your customers who have overdue balances to start bringing some cash in. What we can measure, we can manage, and cash flow is a great example of being able to use the data within our financials to help us better predict what is coming ahead for our business. The better we are at understanding what these numbers tell us, the faster we can react to today's changing business environment. I want to thank you guys all for joining me today for our webinar on cash flows. Please join me back next week at this same time, where our topic will be loan amortization. I hope to see you guys all back next week, and have a great day. Thank you.